The real estate sector is almost flat so far this year. In fact, it's actually in the red for the year since January. Our next guest says that the sector just wasn't able to attract sufficient funds this year, and investors were more attracted to higher momentum sectors like AI and precious metals. Not surprising, really. Let's get more now from Lorne Kalmar, analyst for real estate at Desjardins. Lorne, thanks as always for joining us.
Thank you for having me. It's always nice to be invited to nice places.
There's lots of nice places for sale by the sounds of it. A rough year. What were some of the main factors for it?
Yeah, so in terms of the actual public securities performance, I know you mentioned that they were negative. We have the REIT sector being or generating a total return of about 8% this year, and that has massively underperformed the TSX, which is up about 30%. And that represents the fourth consecutive year that this has happened. So pretty disappointing. But with all that said, that was actually in line with our expectations heading into 2025. We had called for 5 to 10% total return. So this had kind of come in right in the middle of that range. And what's really happened, in our view at least, is, the REIT dedicated investors have been there and they've been shuffling around better ideas, better valuations. But what the sector has lacked, as you alluded to earlier, is that incremental capital, right? And that comes from the Canadian generalists, as well as foreign investors. I'm talking, a lot of U.S. REIT dedicated investors that have pulled back from the sector. And what we saw is, as rates began to rise in 2022, the Canadian generalists went away, and they really haven't come back. And to be honest, as much as I'd like them to, I don't really fault them at this point. And, on the U.S. side, what happened was a lot of them were really active in the multifamily space up until very recently, but the changes in the immigration targets and population growth outlook caused a big retreat there. So we've been sitting and waiting and wishing and hoping, but alas, so far that funds flow that we've been waiting on has yet to materialize.
What do you think it's going to take to get those investors interested again?
Yeah, it's a good question. I think, as you well know, real estate is very tightly tied to the economy. The economic outlook in Canada has been, sluggish, modest, maybe at best. And we think we need to see a turnaround there. This year was characterized by a slowdown in population growth. I think the print that came out for Q3 was the first decline since the pandemic. And then we've also
largest
had,
ever too.
The largest ever. Yeah, so there you go. We've had elevated unemployment. And then you've had all this noise around the tariffs, which has really spooked a lot of people. So I think that, we need to see the economy really start moving in the right direction. I think a part of that will be execution on the federal government side, which, there seems to be a lot of good plans in place. But what's the saying? The road to hell is paved with good intentions. So it'd be great to see some execution there and get people more excited about the economic outlook. We think that would do a lot to attract funds back to the sector. We also think that you need to see, maybe some M&A start up again, although we're of the opinion that the setup for 2026 probably isn't really conducive to that. And, a little reprieve at the long end of the curve, right? The 10-year yield is actually higher. The GOC yield is higher than where it was to start the year, so you didn't really get much help there. And then it could also be, some of these higher momentum ideas starting to fizzle out. You're hearing a lot more about the AI bubble bursting. So, one of the things when we look at our sector from a valuation perspective is that it's actually trading at a historically attractive valuation versus the TSX. And how we look at that is we look at it on a price to earnings multiple gap, and it's trading at a gap that it's only reached about 5% in the last 10 years. So while we don't necessarily think that leads to double-digit returns, in the event that, some of these, as I mentioned, higher momentum ideas start to fizzle out, or maybe there's a broader sell-off, we think REITs offer defensive attributes and compelling valuations, which should hopefully insulate it better than the broader market.
And are there any subsectors that surprised you with their performance or had better years than expected?
I would say there are definitely some that had better years than expected, but they were very much as expected. Or sorry, had a better year than others, but were very much as expected. The big winner this year was seniors housing, which isn't surprising following the post-pandemic recovery. We've seen occupancies accelerate and acquisition activity accelerate, at least on the from the public names that we cover. and you're seeing, sector leading bottom line growth, which has generated a lot of interest. And that's one of the few areas where we actually are seeing that generalist capital, that US capital. And it really shows you how much that can move the needle. Retail had a pretty decent year. I'd say fundamentals there remain pretty darn robust, and they delivered about a 15% total return. And then industrial was just behind that at, I think, about a 14% total return. So those were kind of the three outperformers. And sorry, I should go back in terms of seniors. I think they're about 35% total return if you include the two senior housing names, and 60% if you lump in extended care. So really strong year from them.
Okay, and if you are looking, you are looking for something, where are those the places to look that you just talked about, or are there some other sectors that are really underperforming, and you feel they're bouncing back? They're going to bounce back.
Yeah, I certainly, real estate operates in cycles, and multifamily had a bit of a tough year. Office had a really tough go, and we are of the opinion they will bounce back. I just don't think it's going to be a 2026 phenomenon. One of the ways we would characterize 2026 is kind of more of the same as it relates to 2025. So we think the sectors that I just talked about, seniors housing, industrial, and retail, will continue to be outperformers. We expect the fundamental setup in seniors to carry over. You've got the aging baby boomer population, very limited supply growth, occupancies now reaching the 95% level. In retail, you're seeing a tremendous amount of demand from retailers, certainly in the value and the grocer category, but also more broadly, which I think is very encouraging, and again, very limited supply. And then on the industrial side, there is a lot of headline noise around the USMCA and tariffs. But our view, and I'm not going to pretend to be an expert on this, but we've talked to people a lot smarter than ourselves, is that whatever concessions Canada does have to make probably won't have a tremendous impact on the type of industrial real estate the Canadian industrial REITs own. Okay. They're set up to have pretty decent growth, and the valuations still look pretty compelling.
All right, we got to wrap it up there. But Lorne, thank you very much for joining us.
Thank you so much for having me.
Lorne Kalmar is an analyst at real estate at Desjardins.